Hey folks, so let's say I could only pick 3 tech companies to hold through 2025. Just 3, no more. What would I go with? Honestly, I'd stay with the big names that are not only leading their space, but also actually turning a profit. If you've already got stocks like Uber, Amazon or SoFi in your portfolio, or you're even thinking about them, this one's definitely for you. Today's video is a mix of investing updates, cool charts, and a deep dive into why I see Uber as more than just a rideshare company. So yeah, same vibes as always, real talk, no hype, and hopefully some insights that actually helps you stay sharp in this market. Alright, my name is Matthew and let's kick it off. First up, check out this chart I came across. It looks at how much revenue companies bring in per employee, and some of the names at the top honestly surprise me. At number 1, believe it or not, a private company you've definitely heard of. Let's just say it rhymes with OnlyFans. Reportedly brings in $37 million per employee. Right behind that is Valve, the game company, and then YouTube. If you combine YouTube with its parent company Alphabet, basically Google, you are looking at about $9.5 million per employee. Other big players on the list includes Nvidia, Apple, Instagram. You get the idea. It's a reminder of just how efficient some of these companies really are. Then there is this other chart I thought was worth sharing. It's a global freedom index for 2025. Each country is scored between 1 and 100 based on how free or secure it is. From an investor perspective, it's good to see both North and South America sitting pretty high on the list. Europe, especially Scandinavia, looks solid too. I live in Europe myself, so hey, I'll take it. Other countries with strong ratings: Australia, New Zealand, Japan, South Africa. On the flip side, places like Russia, China, Afghanistan, and parts of Africa score really low. So, if you are thinking globally with your investments, that's something to keep in mind. And here is a random stat I found encouraging. Air travel has never been safer. In 2023, there were just 3 deaths per 100 million passengers. Compare that to 1970s or 80s, and yeah, flying back then was way riskier. These days, it's statistically safer than driving a car. Okay, now onto something that's been stirring up headlines again. Elon Musk. He's apparently launching a new political party called the American Party. I'll be honest, a lot of Tesla shareholders have been hoping he'd dial back to political involvement, and instead, well, he's doubling down. Make of that what you will. Let's pivot to tech stocks. When most people hear tech, they instantly think of the usual suspects: Nvidia, Apple, Tesla, Google. Totally fair. They're giants. You could also throw in names like Meta, Salesforce, or ASML. No argument there. But here is my take. Uber belongs in that conversation too, and let me tell you why. Uber's not just the ride-hailing app anymore. It's built out a full-on tech ecosystem, from logistics to payments to AI and more. They've got partnership all over the map, and they're quietly positioning themselves for some pretty major long-term plays. One of the biggest recent moves, Uber's collaboration with Waymo to roll out autonomous rides in Atlanta. That strong signal that Uber's not sitting out the self-driving future. They are leaning into it. They are also growing fast in Brazil, partnering with iFood to expand grocery and pharmacy deliveries. In the UK, they teamed up with autonomous vehicle company called Way. So yeah, Uber is putting self-driving cars on the road there too. And then there's Lime, the electric scooter and bike company. Uber owns a stake in it, and Lime's going public soon, as a profitable business no less. They pulled in $686 million in revenue and are free cash flow positive. That IPO could be a nice little bonus for Uber down the line. But here is the part that really changes the game for me. Uber is now moving into AI data. They've just launched something called Uber AI Solution, which is now live in 30 countries. Basically, they're taking the massive amount of data they've collected from rides, orders, users, and offering it as a platform for other companies to tap into. We are talking about valuable info: spending habits, demographics, location data, customer behavior. That kind of data can be used across all kinds of industries: finance, legal, logistics, even coding and science. This is the kind of shift that turns Uber from a mobility company into a foundational tech and data company. They're offering audio, video, image, and text data for AI training, which makes them a serious player in the AI infrastructure space. And they are not stopping there. Uber also partnered with Everride, a robotic startup, to roll out food delivery bots. You can already see them cruising around Austin, Texas. New Jersey's next. Want to know what it looks like? Picture a little robot rolling down the sidewalk, dropping off your burrito. It's happening. Now, just to keep it balanced, I'll say this. Uber's dominance isn't guaranteed. Companies like Tesla, Waymo, and Zoox are all coming for that same space. If robotaxi really take off by 2027 or 28, Uber could find itself on the defensive. But here is the counterpunch. Uber just locked in a deal with Volkswagen to roll out 500 fully electric autonomous vehicles in Los Angeles. And the Volkswagen design, honestly pretty slick. This move shows that Uber's not just reacting, they're strategically placing bets to stay ahead. And here is the kicker. Once Uber fully shifts to self-driving, they could save around $2 per mile by not having to pay a human driver. That opens the door to better margins, stronger earnings, and more room for growth. As of now, Uber serves over 170 million people per quarter. Year-over-year growth still coming in at 14%. Bookings up 18%. So yeah, things are still look strong. That said, I'm noticing a bit of slowdown in momentum. Is it a short-term dip or the start of a longer trend? We'll have to watch that closely. Revenue still climbing, up 17%. Earnings per share are a bit choppy, but the direction is solid. And free cash flow, honestly, it looks great. Let's talk valuations for a second. Uber's price to free cash flow multiple is sitting at 18. Free cash flow is growing at 22% this year, and next year it's expected to hit 24%. So, if you are doing the math, Uber's growth is outpacing its valuation multiple. That means its price to free cash flow growth ratio is actually below 1, and that's something you don't see every day. Still, I don't want to sugarcoat it. There is real competition out there. Tesla, Waymo, Zoox, they are not sitting still. So, if you are thinking of buying it, keep that risk in mind. Personally, I don't currently hold Uber in my portfolio, but I do see solid upside over the next year. My target range somewhere between $110 and $120 per share. Let's move on to my second tech pick, Amazon. Honestly, it needs no introduction. We all know what Amazon does. Their largest revenue stream still comes from online retail, the second biggest third-party seller services, where businesses use Amazon's platform to sell their own products, often with full control over pricing and fulfillment. Then we've got their other revenue engines, advertising, subscriptions like Prime, and of course, AWS, the Amazon Web Services. Last quarter, Amazon delivered strong numbers. Revenue rose nearly 10% year over year. Operating margins climbed 12%. They beat earnings expectations, and their forward guidance came in strong. AWS alone grew 17% year over year, a cash printing machine with operating margins close to 40%. That's elite. Meanwhile, Amazon's ad business grew 19% in Q1, putting it right behind Meta and Google in the digital space. But take a look at the 2025 projections. Amazon is on track to outpace Microsoft, Meta, YouTube, and even Google in ad growth. It's turning into a serious ad tech powerhouse. And it doesn't stop there. Amazon is also the world's largest robotics company now, celebrating the deployment of over 1 million robots. Thanks to its AI system, DeepFleet, they've slashed robotic delivery times by 10%, which means faster, cheaper, and more scalable logistics. Those robots are now working in over 300 facilities, and Amazon is just getting started. They're expanding full automation into the UK next. And here is something you may not know. Amazon is also entering the space race. They've launched Phase 2 of their satellite internet system, QPeer, directly competing with Elon Musk's Starlink. Whatever Amazon touches, it either dominates or disrupts. I currently have Amazon at around 4% of my portfolio, and I have no plans to reduce that anytime soon. Unlike Uber, I actually think Amazon is fairly valued right now. Its PE ratio is around 36, but if you compare that to the 10-year historical average, it's hovering near its lowest range. Revenue growing steadily. Earnings per share, strong upward trend, aside from that blip in 2022, but the long-term picture looks great. Free cash flow, that's where things get exciting. Amazon is expected to generate $36 million this year, then double the next year, and nearly triple it by 2027. That puts us near $100 billion in free cash flow within just a few years. Cash from operations is growing at 20% now and is projected to hit 24% next year. With a price to operate cash flow multiple around 20, Amazon's free cash flow growth ratio is under 1, which is very bullish valuation signal. Now, let's talk about my final pick, SoFi. Yes, valuation is a bit elevated right now, but I still think the long-term potential is compelling. In just the last 3 months, SoFi stock is up nearly 90%. It's trading at PE of 51, but let me walk you through why that might not be as crazy as it looks. SoFi is a full-fledged fintech platform, taking aim at traditional banks like JP Morgan and Bank of America. They offer banking, investing, credit cards, loans, a highly diversified digital financial suite. User growth is up 34% year over year, and product adoption is up 35%, meaning users are doing more business with SoFi than ever before. Revenue guidance is at record heights, up 33%. EBITDA growing 27%. Net income just turned positive, now up nearly 10%. And one of the most important segments, fee-based revenue. And here is why that matters. When a user takes out loans via SoFi, they don't lend their own money. A third party does. SoFi just collects a fee, meaning they avoid most of the financial risk. Even in a recession, SoFi remains insulted. The lender carries the exposure, while SoFi still collects fees, and those fees are growing fast. They're also making moves into crypto and blockchain this year, expanding their footprint even further. Now, back to valuation. SoFi's PE might seem high, but look at CEO Anthony Snowto's forecast. By 2026, he expects earnings per share between 55 and 80 cents. This year's projected earnings per share is around 30 cents. If we apply a conservative PE multiple of 40, not 60, we get a target price of $12. But today, the stock is already trading near $18 to $19. So yes, it looks overvalued right now. However, the market is always forward-looking, and if Noto delivers on just the lower end of his forecast, 55 cents earnings per share, using that same conservative multiple, the fair value becomes $22. That would mean a potential $3 to $4 per share upside from current levels. Now, if SoFi hits the upper end of that 80 cents earnings per share target, we could be looking at a share price of $30+. So here is my honest take. I was too cautious when the stock was cheaper, and now I'm watching it run. But if SoFi drops again to the $14 to $15 range, that's where I'd look to buy. From that level, I see potential upside of 50 to even 80% over the next year. So those are my 3 picks for 2025. Not the usual mega cap, cheap names, or AI hype stocks. I wanted to bring you something different, a fresh angle on tech. Uber, Amazon, and SoFi. My top 3. Let me know which 3 tech stocks you like the most right now. I hope you got some real value out of this breakdown. That's what I am here for. Thanks for watching, and I'll see you in the next one. Take care.